Welcome to Handcrafting Your Retirement with Brett Ramsey from Artisan Wealth Strategies. In this podcast, we help retirees as well as those who are considering retirement overcome generic wealth management advice that limits your future. We do this by handcrafting customized financial strategies centered on your unique lifestyle. Jump on board for this journey where we delve into strategies that can help make your money outlast you, as Brett draws from years of experience with guest experts to eliminate cookie-cutter saving strategies.
Hello and welcome to Handcrafting Your Retirement with your host, Brett Ramsey, where we talk about what you want in retirement and how to make it happen. I'm Wendy McConnell. Well, hey there, Brett.
Hi, Wendy. How are you today?
Oh, I'm good. I'm always good when I can see your smiling face and hear one of your just gold star stories.
Well, I don't know if my smiling face is what most people want to say. Is all of my friends have told me I have a face made for radio.
Oh, not
but hopefully my dulcet tones and my voice come through well in these podcasts here, and I not only put you to sleep, but I help you kill a few minutes on your drive time. It's very strategic here. I've been coached well on how long these things are supposed to last, because it's supposed to be exactly how long it takes you to typically commute to work. So our podcast is designed very strategically. And given that, I was thinking about our topic today is we're going to be talking about portfolio construction. We've just gone through an election cycle. Our clients have a tendency to have lots of questions towards the end of the year. And as we start to think into the new year about how do we invest? And to me, when we're talking about these things, it always reminds me a bit of a journey, right? Because portfolios are not really designed for just one point in time, but they're designed to take us over time. And so oftentimes I think about traveling in my car and the things that I've done. And I'd like to think of myself as a pretty darn good driver. I would like to think of myself as someone who, when I put together a plan and I know where I'm going, that I have a tendency to get there, that it may not always be the most direct route, but every once in a while, I put together a plan and I kind of get going. And sometimes, I'm not perfect, right? Things don't go exactly the way that I thought they were going to go. And so one night in particular, and this goes all the way back to high school, I had this car, and on the car dashboard, it wasn't real reliable. And what I mean by that is when I would look at the display, it wasn't always going to be super accurate in terms of exactly how fast you were going. We found out over time that the speedometer didn't quite work perfectly well. We don't always remember why that happened. We just remember that, but some of the other gauges weren't great. And unfortunately, one night, one of the gauges that we found that wasn't quite right was the gas gauge. And we thought we had gas, but we didn't. And so there we were. There were three of us, and we were trying to get somewhere on time and try to get to a specific place, and we just flat out ran out of gas. And if you ever run out of gas at the bottom of the hill, which is where you usually run out of gas, and you realize how heavy that stupid car was a 1976 Pontiac Grand Prix, and our desire to try to push it back up the hill wasn't exactly the easiest thing to do. And the reason why I tell that story is that I think oftentimes our clients, they get caught up in they forget kind of like what their long-term plan is. And then they get to a situation where they find themselves either at the top or the bottom of the hill, but they don't quite have the right stuff to finish the trip. And so oftentimes you get to the bottom of the hill, like I did that night, and you're out of gas. And you don't have the right stuff to get the car back up the hill. And so the reason why I tell that story is how important it is to have a plan, but to also just have all the right components and have all the right pieces so that you don't get temporarily caught off guard once again at the top or the bottom of the hill. And right now, when we go through these moments in time, we start seeing outside indicators and people are elected or unelected that we wanted to be elected, or the right person, this, that, or the other thing. We overreact to all that, and we kind of forget about the total journey. And when we lose sight of our gauges and our things, and they're maybe not quite giving us the right indication, we can kind of get caught off guard and kind of run out of gas, so to speak, at all the wrong times. And so The reason why I wanted to invite Joyce on today is because that's why we have to come with our outside partners like we have, and I'll let Joyce kind of give her whole background and tell you about it. But it's a good time for me, I think, sometimes to take a step back and say, hey, man, if I got gas in the tank, are we ready to go on this journey? I may not know exactly where I am. I may not be at the bottom of a hill. I may be at the top, or I may be right in the middle. And we just don't know, and we don't have perspective sometimes. And like I said, I remember trying to push that stupid car up that hill. It's a good way to give you perspective, right? As a heavy car, and it's hard to push in the wrong direction when it doesn't have the right stuff in it. So hopefully we're going to help you avoid that and help you where you're not running out of gas at all the wrong time. And that we keep a bigger perspective sometimes on where we are on the hill, and make sure that we don't overreact and think we're at one spot in the hill when we just really aren't. So with that, I'd like to introduce Joyce and let her give us kind of her background and tell us a little bit about how she got to be where she is today.
Hi, Brett. Thanks for inviting me on today. I recall meeting you in Carmel, just a month or two ago, and there's so much going on in the market, and I was sharing with you some of the reasons I love being a fixed income portfolio manager. And it's really the fact that, as a fixed income manager, there are so many different factors that can affect bond markets. Like you said, it's, I like to equate it to almost like golfing, which is something I love doing in my spare time. It's like, almost like we're hitting shots onto a blind green. It's like you think you know where you're aiming, and you think you know how much club you need, but all of a sudden the wind picks up and it blows your ball off course, right? And so you don't really know exactly where you're landing. And that's what I love about the day-to-day of being a bond portfolio manager. Not only do we have things like elections and geopolitics coming into play, but it's different things like fundamentals of companies, consumer behavior. So a lot of it tends to be, it's different every day, and you're really thinking about all sorts of different factors that can affect bonds. So for me, I went to business school undergrad at the University of Pennsylvania at the Wharton School, and I always knew from a young age that I wanted to be in the business world. I just didn't know exactly how I wanted to do that. I just know being very interested in economics and what was driving the economy and what was happening. And I got very lucky and I fell into fixed income analytics. So I always like to tell the story about how the beginning of my career in finance really started at Lehman Brothers. So I was one of the lucky people who was, walking their things out in boxes in September of 2008 because I wasn't sure if I was going to be allowed in the building the next day to go back to work because of the bankruptcy that was expected. And luckily for me, I was able to stay on through the transition at Barclays after they acquired Lehman Brothers. And I spent a number of years on the sell side, so doing fixed income research. And I grew to love the analytics and the quantitative things behind it. But what happened about 10 years ago is I got the opportunity to move into the asset management side. So being able to work directly with advisors and institutional investors, talking about solutions to their problems. And I think I shared this with you when we met in person, but one thing that's been interesting to me over the decade I've been on the asset management side is that whether you're talking to an individual investor who has, $50,000 or $100,000 in the market, to large sovereign wealth funds who are managing pensions for an entire country, a lot of the concerns and a lot of the worries they have are the same, right? People want to make sure that they can make sure their investments follow their plan. And it's just on a greater scale when you talk about institutional investors, but everyone's really looking at the same things and trying to figure out, if they have enough gas in the tank to get there.
Yeah, and I know that when we were talking specifically, obviously with a lot of concerns around what projections or things may occur. We were talking right before the election. Now we're post the election. So we once again maybe have a little bit more clarity in terms of what the direction may be. But I found it very fascinating is the research that you guys had done in regards to, really regardless of what the outcome was in the market, you guys saw some pretty consistent trends continuing to move forward. So maybe you could just share those with our audience a little bit about what you guys see as the kind of the top trends and things that are going to be occurring over 2025, as we look there, and share that a little bit with our audience.
Yes. And so I think the top thing that we were thinking about going into the election is that consumer sentiment around the economy tends to be the primary driver of White House party changes. And we know that consumers have been feeling pretty negative about the economy. Everyone's feeling the pressure of high prices over the last few years. And the Republican Party was really able to capitalize on that and not only win the presidency, but we also just got confirmation that they've taken Congress as well. So we have a full red sweep, which is one of the scenarios we had talked about. So when you look at historical trends, that was really pointing towards the outcomes that actually did occur. Now, after that, it becomes a little bit less clear. So I know over the last, couple of days or weeks since the election outcome has been decided, we've seen certain sectors and certain companies exploding, right? So we know Tesla and Elon Musk have really ridden this wave of popularity. Bitcoin has done very well. And that's where I think investors should take a step back. Because what our research has found is that a lot of the assets or sectors or investments you might think will outperform during a specific president's term, it's generally the opposite. So, for example, back when Bill Clinton was campaigning, he made healthcare reform a big part of his platform. And naturally, healthcare stocks were down that year. However, during the 8 years he was president, healthcare stocks were actually one of the best performers during his term. So it's not really easy to predict or to say which sectors are going to be winners or which types of investments might actually do well. And of course, we did say we do have Republican control of the White House, the Senate, and the House of Representatives. But even within the Republican Party, there's debate about what policies they want to push forward, how much of the proposals that President Trump has spoken about will actually be enacted. We know that the presidency has some pretty significant impacts on things like tariffs. He can do that with an executive order. But there's a lot that he's talked about that can really only be done through legislative action. And so again, it's to be determined where the party is going to fall in terms of how much and how far of we will see his policies being passed through. So I urge people to kind of think about taking a more balanced approach in changing their asset allocation. Again, we don't recommend making short-term decisions based on one outcome. Again, over time, we found that markets perform well under both Republican and Democratic parties, and we've seen markets generally trend up over time. We think it's important to stay invested. Another part of our research that really was important to communicate to investors is that the best outcomes are achieved when you are invested prior to the election, during the election, and after the election. So, we don't want to see people make any rash decisions if the outcome that they were hoping for wasn't achieved. They decide to pull their money out of the market. We have seen, again, over time that over multiple presidencies that being in the market, time in the market is the key indicator for success.
Right. And we can't emphasize that enough here at Artisan. We have looked at this research time and time again, and exactly what Joyce said is, it's time in, not timing. And we can go over the little charts that are in our conference room time and time again with people of why we believe that. And that's what this message is about, right? Is that we need to make sure that we keep our eye on the long road in front of us, not just the short turns or where we might be in this particular moment, because it's very difficult for anyone, even people like yourself that spend all day looking at this, trying to properly predict weeks and months at a time, right? We can look ahead and maybe look at years a little bit more smoothly. But I thought that that's really important, and we don't try to put a lot of emotion. I get joked at all the time by one of my closest friends. He calls me the Tin Man. He says I have no heart. And I said, well, I don't know if I have no heart, but what I try not to do is allow my temporary emotions to override what I know to be true over time. And so that's why we believe time in, not timing of these key markets. So I thank you for reinforcing that for our listeners today, because that's something we want to have consistently come out. I think, as we look past this election cycle, and you talked about all of the things that are what I call policy related, which are to be determined, right? We don't really know. You brought that out. I mean, picking out the differences between what can be done with an executive order versus what has to be legislative and those kind of things. Way too many topics for us to dive in today, but I appreciate you bringing that home again. We've been trying to reinforce that with our clients, is that we'll see what policy actually gets enacted, and it's not done, and then once it is enacted, we'll have to learn the time of when it will actually be enacted. And so that's why, as you had stated, like thinking back to the Clinton administration, it may take a while for certain things to come to pass, and they may not come to pass in exactly the same areas that we had anticipated right now. So, but one thing you did bring up, which I think is really crucial for our clients to understand, because just recently, like within the last 24 hours, I'm reading about a recommendation in regards to the Federal Reserve, which obviously with interest rates, and I know that's your area of expertise far more than mine, but maybe share with our listeners a little bit about what we think is happening in terms of inflation and where we think interest rates are. And then another word that I think you're going to bring up is this, I hate using a word I call a fancy word, but duration, which is just simply how long do we think these things may be? Do we think they're a 1 year, 3 year, 5 year kind of a thing? Because all of that impacts our choices in terms of how we invest specifically in our fixed income portion. So maybe you could just share with us a little bit about what you guys are seeing or thinking in that area.
Yeah, absolutely. I mean, I think over the last 4 years, most of this country knows who the Federal Reserve Chair is, and they're paying attention to every press conference that's happening. So we really haven't seen that in a while. But of course, we know that Jerome Powell, we have the next rate decision coming up in December. They did cut the expected 25 basis points in November following the election. The concern right now is the Federal Reserve is going to try and balance the inflation concerns with the strength of the labor market. So we know the labor market has experienced a little bit of weakness recently, and the data has obviously been a little bit volatile. As we know, we had several hurricanes happening in October that affected those numbers. So we will get a fresh read in December. The labor market has shown some signs of weakness. So the Federal Reserve cut rates in response to that. But on the inflation side, and this is where I have some concerns, I think it's personally a little too early to say that the war against inflation is won. We know that, President Trump is very positive on pushing through tariffs, especially against China and some of the other trade partners where we have a deficit with, right? So we want to be able to factor in how that could affect prices at home. I think, again, it's too early to know exactly where the tariffs are going to go and how companies will respond to an increase in goods that they're importing. But what we saw the last time in his first presidency is that some of the companies at first absorbed some of the extra costs. So we know that actually was, though, pre-COVID, right? So companies had a little bit less pricing power over consumers at that time. So they did absorb some of the higher costs up front. And then as it went on, they did hike prices a little bit. However, we know that consumer behavior has changed since the pandemic, and that companies have been taking advantage of sustained higher consumer demand for goods and for travel and things like that. So this time around, under his second term, if President Trump does pass even higher tariffs, will companies be as cautious about pushing prices through to consumers? That's to be determined, right? And there's different thoughts about how tariffs affect prices over the long term. In the short term, of course, if companies do pass through the higher cost of goods to consumers, that'll be a one-time price adjustment for sure, right? Now, the question is, how does that factor into longer-term prices? We don't think it's necessarily a sustained increase like we saw in 2022 when inflation kept going up month over month over month. Tariffs are generally thought of as like a one-time price change. So the Federal Reserve might look through that and continue their rate-cutting campaign to support domestic employment and growth. But it is something to think about, right? Because that could change consumer behavior. I mean, it's kind of semantics, right? Is it a one-time change in price or is it inflation? People will just look at the sticker on whatever they're buying and be like, wow, like I can't buy as much today, right? So they're going to cut back on spending most likely. So that's one factor that's very important to consider. And that's going to drive the Federal Reserve's rate decisions. Again, the outlook is a little cloudy, right? It's fuzzy, right? We need to see how companies react to the policies. Well, first we need to see the policies, right? And then we need to see how companies react, and then we'll see how consumer behavior changes in reaction, right? So it's kind of this chain event, but at the end of the day, we do believe the Federal Reserve is likely to keep reducing their short-term interest rate. And to answer your second question about the duration question, how does that impact fixed income investing? So when rates go down, prices of bonds go up. It's this neat little inverse relationship that we have in the bond market. So the way we are positioning our portfolios is on that kind of shorter to intermediate part of the yield curve, where we expect rates to continue to go down. And we are a little bit more cautious on the long end of the curve. Again, the short end is more highly correlated to Fed activity and short-term inflation expectations. The intermediate part and the long end of the curve is more tied to longer-term future growth and longer-term inflation expectations. And we just said, we're not sure yet, right?
Yeah.
That's going to be less correlated. So we recommend staying shorter duration, not taking on as much interest rate risk, because we don't know with confidence the future path of interest rates right now.
Right. And so that's some very practical tools that we put in place with our clients because we reach out to our experts like Joyce to help us navigate these things. And so that you'll be reflected in quite frankly, how we're managing our clients' money right now. But I think always very important, I think that Joyce brought out that currently the Fed has two clear mandates. Their mandate number one is related to inflation. So if inflation, their target is 2%, to keep things super simple. I won't overcomplicate that story today, but and if it's above 2%, then that they need to actually increase rates because they would be trying to bring inflation down. But their other mandate is related to employment. And so as employment changes and ergo unemployment increases, then they're trying to increase the economic activity, which would be lowering rates. So they've got this little battle that they're in, and that's their job. And that's why it's hard to predict right now, because there are some policy changes that might impact both those things. Right. And so if inflation were to go up, then continuing rate cuts doesn't make any sense. However, if unemployment were to go up, then we need rate cuts to try to spur economic activity and employ more people. So that's what I call it. TBD. Everybody stay tuned, right? Because I think this is going to be an interesting ride. So, in your role, you talked about you getting an opportunity to see what if you were to kind of say, hey, right now, if I were to give what I always say is, what's your best advice? Like, what one piece of advice would you be like for your own self? Like, if you're sitting there going, yeah, I'm talking like my mom and dad, and I want to help them, navigate this. How would you be coaching them through that?
So, we talked a little bit about risks in the market related to economic variables or policies under different administrations, things like that. So that's all kind of like the obvious risks, right? I would say the hidden risk that I don't think a lot of people are talking about is reinvestment risk. We know that a lot of people during COVID were able to accumulate pretty significant excess savings. And a lot of people put that in cash because finally, for the first time, because the Federal Reserve was increasing interest rates, you were getting a pretty healthy yield on your cash just to keep it in your bank account or a high yield savings account, right? Now, as we said, though, right now we believe the Federal Reserve is on a rate cutting path. And so as that happens, if you look at some of your high yield savings account and your bank account, you've probably already started seeing the yield go down. So what I am concerned about is if inflation stays at 2.5%, 3% this year, and the yields continue to fall on cash, you're kind of at a 0% real return. So I'm urging people to take a look at their asset allocation and to make sure to be invested in the market. So whether that's moving out to some short duration bonds like we just talked about, or investing in equities. Of course, it depends on people's specific situation and their goals and their financial plan as to where the cash should go. But I do think people need to consider that reinvestment risk. Again, we want to be in the market. And so while cash has been a really good place to be over the last few years, that opportunity is starting to decline. So just urging people to think about that and to be able to reallocate at year end when it makes sense.
Yeah. Joyce brought up one of my favorite nerd words of all time, which is real returns. And people, and all that means in an economic standpoint is our actual real return is what we earned minus essentially the rate of inflation, so to speak, so that I can continue to buy tomorrow at least as much or more than I buy today. And I think that's a real challenge, especially for some of our older clients that it gets hard. We use fancy terms like, aggressive and conservative and words like that in our profession. But what really is our timeline? How long before we need the money? So you'll have to listen to some of my past podcasts. But if one of our favorite things is we got to know when we need it. And we want to make sure our investments are appropriate based on when we need to consume it. And that's really, I think, a great point that Joyce is making. Over the last couple of years when interest rates were higher than they have been in a very long time, it gave us an opportunity to invest into some short duration things, which would be like the bank assets, and those things may not be the right place for as much money as they were in the past. I'm not saying they're bad. I'm just saying that things are changing and that we need to constantly review that. And that's why it is a process, and why, back to my original story, sometimes when we're putting our plans together, we got to make sure that all of our gauges on our car are right, that we can know exactly what we got in the tank and how everything's running. But that also, as we start on that journey, not only are we checking our gauges, but we got to make sure that we continue to reevaluate where are we and where are we going, so that we don't end at that bottom of the hill in that 1976 Pontiac Grand Prix trying to push that sucker back up the hill, because that sucker was heavy. Let me tell you, it was heavy. Anything else you'd like to share with our audience today, Joyce, before we wrap up?
No, thanks for having me. I think this is a very interesting time to be in the market. I think we'll get a lot of interesting data coming out in the next few months. So hopefully next time we can talk more about where we see the path forward, because hopefully we'll have a little more clarity. But as always, we just try to do the best with what we can and make adjustments in real time.
Wonderful.
All right, Brett. So how do people get in touch with you?
Well, I'm not that hard to find. I'm a big fella. I'm easy to spot in a crowd. I never have to worry about that. I never get lost at the game. I'm always found. But the best way to find me is on that wonderful world wide web out there. You come to our website, and I know it's a big mouthful, but artisanwealthstrategies.com. You can find me right there. You can get on my calendar. And I know Wendy hates it when I quote Saturday Night Live skits from back in the 80s, but one of my favorite comedians during that time was a guy named John Lovitz, and he had this great skit, and he would always say, "Get to know me." And I can't help you if I don't know you. So click on that, get to know me, let me get to know you, and then we'll try to figure out what's right for you, because ultimately it's handcrafted for your confident retirement, and we can't craft it for you if we don't know you. So that's how you find me, and that's how we get to work together.
All right. Sounds good. So please like, follow, and share this podcast with your friends. Thank you, everyone, for joining us. And until next time, I'm Wendy McConnell.
Thank you for listening to Handcrafting Your Retirement. Visit our website at www.artisanwealthstrategies.com or give us a call at 317-660-2855. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Artisan Wealth Strategies. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA, SIPC.
All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Past performance is no guarantee of future results. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price.